Welcome to This Week in Crypto from K33 Research. Today is August 14th, 2026. If you want to dive deeper into any of the topics we cover today, you'll find all of our research at k33.com/research. We have 4 stories to get into this week. New portfolio data shows that Norway's sovereign wealth fund ended the first half of the year with more indirect Bitcoin exposure than ever before. Separately, a controversial Bitcoin fork failed almost immediately. Nearly 14,000 Trezor customers had personal information exposed through a shipping partner. And Tether finally completed something it has been promising for years, a full financial audit. Let's start in Norway. Norges Bank Investment Management, or NBIM, published its portfolio holdings for the first half of 2026 this week. And when we ran the numbers, one thing stood out. Its indirect Bitcoin exposure continues to grow. As of June 30th, NBIM had exposure equivalent to 11,549 Bitcoin. That's up just over 2,000 Bitcoin from the end of 2025, or roughly 21%. The important distinction is that NBIM hasn't announced a new Bitcoin allocation. In fact, its mandate doesn't allow the fund to simply go out and buy Bitcoin directly. The exposure comes through shares it owns in listed companies that themselves hold Bitcoin. So this is less a story about Norway making an active Bitcoin bet and more a story about what happens when Bitcoin becomes embedded in public markets. A broadly diversified investor can gradually accumulate Bitcoin exposure simply by owning companies such as Strategy, Block, and other listed businesses with Bitcoin on their balance sheets. That's what makes the trend interesting. NBIM's indirect Bitcoin exposure actually grew faster during the first half of the year than Bitcoin holdings among public companies overall. At the same time, Bitcoin's weak performance meant the value of that exposure went down. Measured in Norwegian kroner, it fell about 20% during the first half of the year. So the fund ended June with exposure to more Bitcoin, but that Bitcoin was worth less. NBIM also now has meaningful indirect exposure to Ether through its stake in Bitmine, equivalent to more than 67,000 Ether. We track NBIM's indirect crypto exposure continuously at K33, and we've made the dataset public. You can find it at nbim.research.k33.com. Now to Bitcoin itself, because the network gave us an interesting governance experiment this week. Supporters of BIP 110 split from Bitcoin's main chain on August 8th. They rejected blocks that did not signal support for their proposed anti-spam rules. The proposal sought to restrict certain types of non-financial data, including ordinals inscriptions. Supporters argued that this activity puts an unnecessary burden on nodes and distracts from Bitcoin's monetary purpose. Critics argued that the network should remain neutral. If a transaction follows the rules and pays the required fee, Bitcoin shouldn't care what the transaction is being used for. In the end, the disagreement was tested in the most direct way possible. The minority fork launched, and almost nobody followed it. Only around 2.5% of miners had signaled support before activation, and the new chain quickly fell behind Bitcoin's main chain because it lacked the hash power to remain competitive. That's a useful reminder of how Bitcoin governance actually works. Anyone can propose a change. Anyone can run different software. Anyone can even fork the chain. But turning that proposal into Bitcoin requires broad coordination across miners, users, developers, and the wider network. In this case, that support simply wasn't there. The debate hasn't completely disappeared. The later removal of Luke Dasher as a BIP editor has created a separate discussion about Bitcoin governance, but the fork itself produced a fairly unambiguous result. The next story is about hardware wallet security, although importantly, not about the hardware wallet itself being compromised. A breach at Trezor's shipping partner, Shipmonk, exposed personal information belonging to nearly 14,000 customers across several countries. Around 11,700 customers had names, email addresses, phone numbers, and shipping addresses exposed. Another 1,900 had names, cities, and email addresses exposed. Trezor says its own systems and hardware wallets remain secure. No private keys were exposed. But for a crypto holder, this kind of data leak can still be serious. Knowing someone's name, address, phone number, and the fact that they bought a hardware wallet gives an attacker something very different from access to a private key. It gives them a target. That can lead to highly convincing phishing attempts and impersonation scams. And increasingly, there is also a physical security dimension. We've seen a rise in violent attacks targeting crypto holders, and similar concerns followed earlier leaks involving ledger customers. So the broader lesson here is that hardware wallet security doesn't end with protecting the seed phrase. Protecting the identity and physical location of the wallet owner matters too. Tether, meanwhile, reached a very different milestone this week. For the first time, the company has completed a full independent financial audit. KPMG in the United States audited Tether International's 2025 financial statements and issued a clean, unqualified opinion. The work covered the full balance sheet, reserves, liabilities, income, cash flows, and systems, with KPMG independently testing the underlying assets and transactions. Tether reported reserves exceeding liabilities by $6.8 billion at the end of 2025. This matters because Tether has faced questions about the backing of USDT for years. Until now, the company has relied primarily on reserve attestations. Those can provide useful information, but they are essentially snapshots of the balance sheet at a specific point in time. A full financial audit goes substantially further. Tether has talked about completing one for years, going back to 2017. So while an audit doesn't end every debate around the company, getting a clean opinion from a major accounting firm is a significant step for the world's largest stablecoin issuer. A few other stories are worth having on the radar. Strategy sold another 1,690 Bitcoin as it continued building its dollar reserve and supporting STRC. BTC Pay Server warned users about an actively exploited vulnerability that could drain funds. BitGo reported an 80% increase in quarterly revenue to $4.3 billion, and Figure nearly tripled its quarterly profits. Stepping back, I think there is a common thread running through several of this week's stories. Crypto is becoming more deeply integrated into the existing financial system, while still retaining some of the characteristics that make it very different from traditional finance. Norway's sovereign wealth fund is gaining Bitcoin exposure through ordinary public equity ownership. Bitcoin governance is still ultimately settled by whether people actually choose to run the software. Hardware wallet users are discovering that operational security extends well beyond cryptography, and Tether is moving toward the kind of financial scrutiny expected of major institutions. None of this requires a dramatic move in the Bitcoin price to be important. These are changes in the infrastructure around the asset, and over time, that infrastructure matters. Thank you for listening to This Week in Crypto from K33 Research. Subscribe for weekly crypto market updates, and remember to visit k33.com/research for our latest analysis and research.